Chris Wood, welcome to Perspectives 2023. We're all super interested in hearing what you have to say. Welcome, and we look forward to your thoughts before we kick off our conversation. Chris Wood, ladies and gentlemen.
My colleague's going to move it. Hello, everybody. I'm very honored to be here. Many years ago, when I was at The Economist, I went to see Sir John in the Bahamas. And just hearing those conversations, he lent me his old Lincoln convertible for the weekend. But as rightly noted, his key point was always that you had to be patient in investing. I'm going to be discussing global issues in charts, and then I'll end with some charts on India, but clearly you all know much more about India than I do. This year has been an interesting year in world stock markets after the declines we had last year, and in many ways this has been the year of NVIDIA. So I'm just starting with this chart on NVIDIA relative to MSCI World, because at the start of this year, the tech sector needed a new story. People were buying semiconductor stocks. The story was that we were going to get a pickup in what I call legacy tech in the first half of this year. So people bought semiconductor stocks. That trade has worked, but the people who bought semiconductor stocks at the start of this year have been right for the wrong reasons, because PC sales, smartphone sales have continued to be downgraded. But clearly, when we had the Microsoft purchase of ChatGPT, the AI theme entered the market, and this is a very powerful theme. And even if we have a recession in the US next year, which is my base case, I think the AI story is a sufficiently strong story that to a large extent it can look through any near-term US economic downturn. But being a more macro person, I'm going to be focused on the big picture issue, which is, are we going to have a US downturn? We started this year with many economists forecasting a recession in America in the first half of this year. That recession has not happened. Right now, the consensus is giving up on the US recession forecast, and clearly that consensus is reflected in a more buoyant stock market. In the case of Jefferies, the forecast for a US recession was always that it would only kick in the second half of this year. I'm not an economist, but what I've been focusing on, when I was a student, I used to work for a hardline monetarist economist at an asset management company, and I did a couple of internships. So he was always, this economist who actually came up with a Hong Kong dollar peg, he was always very focused on money supply. And the reason I altered my long-term disinflationary view of the world, which I've had since the mid-80s, the reason I altered that at the early 2020 was when I saw this explosion in M2 growth in America, which you can see, the chart before, yeah, on this chart. So you can see that dramatic explosion in M2 growth, and that's what caused the pickup in inflation in the G7 world we've seen in the last 2 years. And the reason we had this inflation is because of the central banks in the G7 world basically printed money to finance transfer payments. So people in the US, UK, and Australia, Europe were basically paid lots of money to do nothing. That's what's caused the surge in inflation. That did not happen in Asia, didn't happen in China, didn't happen in India, didn't happen in Indonesia, and that's why we haven't had the same inflation problem in Asia, or indeed emerging markets. That was the history, but right now M2 growth is collapsing. So that collapse in M2 growth looks worrying from the standpoint of economies and asset markets because it looks bearish. However, the most important chart in this presentation right now is the following chart. That is US M2 to nominal GDP growth ratio. And the reason this chart is so important is because it's highlighting the base effect. Because the M2 growth was so large back in 2020 that it's going to take time for the liquidity contraction to go back below trend. So what this chart highlights is the peak of the money printing in 2020. We were 28% above trend. We are now, based on US 2Q data, 4.4% above trend. So this liquidity tightening is only really going to start to bite when we go below trend, and it looks like that's going to be in the coming quarters. So my key message is that monetary policy works with a lag. Next chart. Clearly, a lot of the classic macro indicators are still signaling downturn risk. This is the inverted yield curve. Historically, there's basically a 12-month lag when an inverted yield curve is first signaled and when it leads to a recession. The yield curve in the US inverted for the first time in November 2022. The history of the last several recessions is the lag has varied between 6 months to 17 months. So again, the history doesn't deny the fact that we could still have a recession. If there's still no recession by this time next year, then I think we'll have to admit something has changed. Fed balance sheet, the Fed is not only tightening, but it's reducing monetary tightening. It's also reducing its balance sheet, quantitative tightening. But that whole quantitative tightening process this year was interrupted when Silicon Valley Bank blew up. So while the Fed has continued to raise rates, the Fed has also done two very significant easings this year. The first was its response to Silicon Valley Bank was to send the message that all bank deposits in America would be bailed out if there's a problem, because about 85% of the depositors in Silicon Valley Bank were rich people whose deposits were above the deposit insurance limit. The second thing the Fed did was to start to lend money to regional banks. And the interesting point about that loan program is the Fed is lending money valuing the bank's collateral, such as treasury bonds, at par, not at market value. So they've effectively warehoused the problem. They haven't resolved it. Meanwhile, the regional bank, the scare over the regional banks we had in the spring has led to a big surge in money market fund flows out of bank deposits, and clearly the money market funds offer very attractive rates. And as a result of post-2008 regulation, most money market funds are now government guaranteed. Meanwhile, where's the credit risk in this cycle? We've had a significant monetary tightening, but we haven't yet had too many credit problems. But in my view, those credit problems are building. One obvious area where there's a problem is US commercial banks' commercial real estate loans. This was described to me on my last trip to America a few months ago as a slow-motion train wreck. There's $1.5 trillion of commercial real estate loans due to be refinanced in the next 2 years. But in my view, the real risk in this credit cycle is not with households, it's with lower-rated corporates. And there's basically three areas of credit risk. One is leveraged loans, which are about $1.5 trillion. Another is private lending, which is about $1.5 trillion. And the third is US high-yield bonds. Now, the interesting point about this cycle is a lot of the real boom in this cycle in the US, which I would say has run from 2009 to 2022, has been in the whole world of private equity, private lending. So normally when you have a monetary tightening cycle, particularly the one which has been as significant as the one we've just had, the problems emerge in the area which has seen the biggest boom and where people have made the most money. And those problems emerge when, as Warren Buffett once famously said, that the tide runs out. So in my view, the most money's been made in this cycle in private lending, private equity. But the interesting point is, and this is one reason why the lags in this cycle can be longer in terms of the lags, in terms of the impact of monetary tightening, is that the practical reality is this whole world of private lending, private equity, is as unregulated as the capital markets, and indeed the Indian mutual fund industry is now heavily regulated. So the practical reality is that people in the private lending, private equity world, there's no real preemptive provisioning pressure from regulators because the regulators don't exist, and everybody in this world is incentivized to delay price discovery for as long as possible. But the leverage loans are interesting because the leverage loans are geared of floating rate note, they're linked to LIBOR, and clearly problems are building in this area because most of these leverage loans used to do leverage buyouts. My understanding is the interest rate risk has not been hedged. Second area, which has been booming since 2008, is the private lending market. This was a huge opportunity post-2008. US banks were heavily regulated, so private funds went in to provide loans. You've seen for not very attractive returns. The green line is the return from this so-called Cliffwater Direct Lending Index. Returns similar to the S&P, but much less volatile. However, the lack of volatility in these returns does raise certain questions. My simple point is the private lending market has not been stress tested in a downturn. In my view, the least risky area in the US lower rated corporate area is the US high yield bond market, junk bond market, because here the US corporates have done a very good job, be they high yield issuers or investment grade issuers, of terming out debt, refinancing their debt, taking advantage of the very low bond yields a few years ago, and that's why corporate bond spreads have so far remained very well behaved in this Fed tightening cycle. This is just a chart showing how investment-grade corporate bonds maturity profile have been extended. Next chart shows another indication of growing recession risk. The green line is a combination measure which is basically charting central bank surveys of the willingness of banks to lend and Fed surveys of the willingness of companies and consumers to borrow. And what you can see is the green line is going down, i.e. reflecting reduced willingness to lend, reduced willingness to borrow. Historically, that green line has been correlated with the blue line, which is real GDP growth. But what's interesting is for now, the US economy is not following the green line. And one explanation for that, the obvious explanation for that, I think, is the aggressive fiscal easing we see in America, which obviously is the opposite of the monetary tightening. Credit growth, though, in the America has turned down. This is a chart of US banks' loan growth. What about the US stock market? Clearly, as recession concerns recede, the market's rallied, plus you've had the AI story. All this chart shows you, the gray shaded areas is what's happened to earnings in previous recessions. So if we get a recession, there's a lot of room for earnings downgrades. Core PCE. This is the Fed inflation measure they used to like to talk about from the early 80s until recently. So even on the core PCE, we remain significantly above the 2% target. An interesting point is what actual inflation measure is the Fed now targeting? Is it core PCE or is it headline inflation? Actually, no one knows, and the Fed is deliberately keeping it vague. But in my view, in the near term, if you're involved in markets, the inflation data is now less important than the employment data, because Fed Chairman Powell is trying to reestablish his credibility and the Fed's credibility as they lost control of inflation following the pandemic. So he's keeping talking tough so long as the employment market is not weakening. So the key issue for markets is what the Fed will do if the employment market suddenly weakens, which in my view is a likelihood in the next few months. Because then the Fed will be put in a situation where it will have to choose between its two mandates, which are inflation and employment. Obviously, anybody can talk tough when everything looks fine. The last employment data was basically Goldilocks. The employment market weakened a bit, but nothing dramatic, which is why my base case is they won't raise rates at the next meeting. But in my view, in a situation where the employment market suddenly weakens, payrolls, say, turn negative, in my view, when you'll get a lot of media noise. My base case is the Fed will then prioritize the employment market over inflation, given that inflation at that point is likely to be still above 2% on a year-on-year basis. In my view, that will then send the message to markets that the Fed is not going to enforce the 2% target, and that would lead to a sell-off in Treasury bonds, but it will be positive for equities, particularly cyclical equities. This is showing you average hourly earnings growth in America is slowing, but not drastically so. Small business survey. Now, I think the small business area in America has become key to watch because we're not going to have a US recession unless small businesses start laying off people because they employ most Americans. The interesting point, one reason we did not expect a recession early this year is because the small businesses in America enjoyed record profit margins in 2022. Why was that? Well, the big positive, you're a domestic demand-focused SME in America, the big positive of the surge in inflation is that nominal GDP growth went up, which meant that your domestic revenues went up. And your revenues last year went up more than your employees' wages, so you had record profit margins. Meanwhile, the last thing you would think of was laying people off because you had a hard trouble getting people to work, to employ people coming out of the pandemic, most particularly as the federal government had paid them money to do nothing. So this year it's going the other way. Revenue growth is slowing. The employees are trying to play catch up on the real wages they lost last year. And you've got the ongoing squeeze from the higher cost of borrowing. Because SMEs in America aren't corporates, they don't have access to the bond market, they can't term out their debt. So right now, this chart shows the average SME is borrowing at a rate of around 9%. So in my view, that cost of borrowing has to at some point have an impact. Meanwhile, it would, from an historical perspective, it would be amazing if the US avoids a recession given the history of Fed tightening. What this chart shows is that all Fed tightening cycles since the Second World War have caused recessions except one. There's one exception, which was 1994, where you didn't have a recession, but you did have a big correction in the bond market. That leads to probably one of the most important charts in global financial markets. This is the trend line on the 10-year Treasury bond yield. And what we see here is very clearly that the technicals suggest we have gone into a bear market on 10-year Treasury. This is the log scale chart going back to 1980 when Paul Volcker crushed inflation in the US. So at the end of March 2020, when I saw the Fed had gone bonkers, basically, because it printed all this money just to address a pandemic. It's not clear why money printing is related to a pandemic. So I said, sell all G7 government bonds at the end of March 2020, and I set up a global sovereign bond portfolio, which I'll show you later. So my base case is we've entered a bear market in US Treasuries, and also G7 government bonds, but I am assuming this fudged by the Fed. If I'm wrong and the Fed prioritizes still fighting inflation when the employment market is weakening, then, you know, the bonds can rally through this trend line. But I have a hard time seeing that politically in the context of the US today with the US presidential election a year away. Whenever Mr. Powell has been stress tested, like he was with Silicon Valley Bank, he's basically shown himself, he moves very quickly. So Silicon Valley Bank was the latest indication in the US that the system has zero tolerance for pain. The other interesting point about Silicon Valley Bank is that it was basically a very unusual type of bank. It was, as one guy said on Bloomberg the week it blew up, it was the equivalent of a highly levered PE fund. So Silicon Valley Bank offered you a bit of an insight in what the trouble's building in PE. Meanwhile, on the US fiscal deficit, as of July, US fiscal deficit was running at 8.6% of GDP. This is almost as high as the worst point in the global financial crisis in 2008, yet the US is right now not in a financial crisis. This is also leading to growing focus on the rising debt servicing costs facing the federal government, which is one reason why Fitch downgraded US sovereign debt the other week. So right now, net interest payments as a percentage of federal government revenue are running at 14% in July, highest level since 1998. In a world where the Fed fudges the 2% target, Treasury bonds sell off again, and the 10-year Treasury bond yield starts trading between 4 and 5%. That's a world where the markets are going to be increasingly focused on the cost of funding these fiscal deficits, and that's a world where you're likely to see growing policies of financial repression in America. Meanwhile, the US has done a much less good, the US government has not, unlike the US private sector, termed out its debt. So 40% of US marketable treasury securities will mature before the end of 2025. And foreigners in recent years have been selling treasuries, and domestics have been increasing their holdings of treasuries. That's been the trend. Clearly, interesting development in the last year, big central bank buying of gold, record central bank buying of gold from the second quarter of last year. That, in my view, reflects central banks globally outside the G7 world reducing their exposure to US treasuries, adding to gold. Why are they doing that? Why would you be buying gold when the Fed's tightening? Doesn't make sense. The reason they're doing it because I think governments everywhere, including the Indian government, were shocked by the precedent created by freezing Russia's foreign exchange reserves following the events in Ukraine. So that's a brief overview of the US. I'll very briefly discuss the ECB, where recession risks are rising again. ECB got inflation as wrong as the Fed. It looks like it's peaked, but again, loan demand has turned weak and loan growth has turned down. But in Europe, actually, the best places to invest in Europe are countries like Italy, Greece, because they're receiving big flows from Northern Europe. Where the real problems are building in the European economy are in Germany. Germany has in many ways committed economic suicide in recent years. First of all, they deprived themselves of cheap nuclear power when former German Chancellor Merkel made a precipitous decision to exit nuclear power post-Fukushima. Then that was a big body blow to German industry. Then you had another massive body blow post the Ukraine invasion. The German industry has now been deprived of access to cheap Russian energy. This, you may think that's the right decision politically, but from an economic standpoint, it's a disaster, as any German businessman will tell you in private. The third issue facing the German economy is the existential crisis facing its biggest sector, which obviously is the auto sector. The German skill set is engineering, and EVs are all about software. Right now, I'm going to turn to an area which is clearly poses a growing risk for India and markets, and that's obviously the oil price. I've been structurally bullish on oil for several years, simply because the attack on fossil fuels by the green lobby, primarily in the Western world, has basically created a situation where the oil industry has not been investing in new oil. Sorry, has not been investing in new production, so there's a fundamental supply constraint. And the other point is that US shale has geologically peaked out. So the consequences of both dynamics is that OPEC is now the swing producer again. So I've been recommending that people maintain energy stocks in their portfolio be it a global portfolio, regional portfolio, or even an Indian portfolio, because if oil goes to 110, 120, everything's going to go down in price except oil, and that remains a risk. And that's the, so energy stocks have been doing well since 2020. This chart just shows what I call the unwind of the ESG trade. The green line is the Alternative Energy Index. The blue line is the World Energy Index. Right now, though, the interesting point about, I said earlier that employment market was key and inflation structurally peaked, but the oil price does create an issue for a near-term inflation scare, which may put the Fed in a very difficult position. And the reason it will put the Fed in a difficult position is because the Fed lost credibility. If oil goes to 120, it's going to be hard for the Fed to say they're only monitoring core PCE and headline inflation doesn't matter. And the other problem for the Fed is a surge in oil based on the history of the correlation. This is a correlation between the Brent crude oil price and US five-year forward inflation expectations, has been 0.86 since 2011. So if oil goes to 110, 120, and that correlation holds, inflation expectations will surge. Then the Fed is obsessed with inflation expectations, rightly or wrongly, but if inflation expectations surge, then the Fed can no longer argue that inflation expectations have not been destabilized, and that's an environment where the Fed will be forced to tighten. That will create a sell-off everywhere, which will then create a massive buying opportunity, because the more oil spikes, the more likely it is to lead to demand destruction. Meanwhile, the interesting point is, why was oil so weak in the first half of this year? Most people attributed it to weak Chinese demand because the Chinese economy has been weak, but actually oil demand in China is back above pre-pandemic levels. So China's not the reason for the weak oil price in the first half of this year. The reason the oil price was weak relates to this chart. That is that the Biden administration, contrary to what it announced in January, has continued to take oil out of the US Strategic Petroleum Reserve, continued to sell oil in the first half of this year. However, it stopped doing that this quarter, and that's the reason, I think, as well as the supply moves by Saudi, why oil has now started to rise. So the Biden administration could start selling more oil from the SPR. However, if they do that, they're going to come under big political attack from the Republicans, because the SPR is now at record low levels. So the Republicans will say, you, Biden administration, are jeopardizing America's security by selling more oil just for near-term electioneering reasons. And they will say the reason the oil price is so high is because your green policies have stopped oil production. So oil has the potential to become highly political in the lead up to the election. Meanwhile, the interesting longer-term point is that based on the agreements made at the recent BRICS summit, where Saudi and UAE have now been formally invited to join the BRICS group, we've got a situation where if these big oil producers end up joining, then as this chart highlights, the BRICS members will account for about 40% of oil exports. And that's a situation where the oil producers get dramatic leverage over the G7 world. And that's not great for India, but the good news for India, and the good news coming out of this G20 summit, which was clearly a diplomatic triumph for the Indian Prime Minister, is that India has got a foot in both camps, which I think is a good position to be in. Meanwhile, from a market standpoint, this going on to emerging markets, Asia, dramatic contrast between how emerging markets have performed in bonds and equities. So the green line shows huge outperformance over emerging market, local currency government bonds, over G7 government bonds since 2020. The black line shows blue line shows big underperformance of emerging market equities. That's two drivers of that. One is US tech stocks rallying, The other is China, disappointing. Clearly, if that bottom line was just India, it wouldn't look anything like as bad. In fact, it would look good. I'm going to jump over this. I'm not going to discuss all my portfolios. Just safe to say my Asia ex-Japan long-only portfolio I've been running for about more than 20 years, actually. I have more than 40% of this Asia ex-Japan portfolio in India. Happy to answer questions on that later. I recently started a global equity portfolio earlier this year because Jefferies wants me to be called the global equity strategist. Obviously, my speciality is Asia. Actually, my global equity portfolio, I have 15 percentage point allocation in India, which is 14 percentage points more than any other global fund. I'm now going to discuss quickly, just run through some charts relating to Japan, China, and obviously India. So on Japan, I think for this audience, the key point to know about Japan is Japan has the potential to create some global waves because inflation, it looks like it's come back in Japan, and at a certain level of Japanese government bond yields, that will trigger Japanese financial institutions who have huge holdings in G7 government bonds, where they hedge the currency and they try and earn extra returns. At a certain bond yield in Japan, Japanese institutions will be incentivized to return their money home because they can now meet their asset liability requirements in a yen world. So I had a meeting with the largest Japanese life insurer in Tokyo in March. I said, at what level of JGB yield does it stop making sense for you to own bonds offshore? So his answer was very simple, 1% on the 10-year JGB, 2% on the 30-year JGB. I think we're about 0.7% on the 10-year JGB right now. So in a world where the JGB reaches 1%, which in my view is a matter of time, is a world we could have a huge capital repatriation back into Japan, big move in the yen, but disruption in G7 government bond markets. Inflation has been above the 2% target in Japan for many months. This is an interesting chart. This is wages in Japan. So the major Japanese corporates, for the first time in 30 years, gave their employees a real wage hike this year, which shows you that the big corporates think inflation's come back. And this is topics relative, but what hasn't happened yet in Japan is you haven't had a reallocation by domestic institutions out of yen fixed income into equities, which is unbelievable actually because the topics has outperformed the 10-year JGB on a total return basis by 269% since the launch of Abenomics in late 2012. So Japan has the potential to be a monster market. The blue sky outcome would be Japanese institutions allocating out of foreign fixed income into yen fixed income, causing a huge rally in the yen. The yen is dirt cheap right now. And then that's followed by domestic institutions reallocating out of yen fixed income into Japanese equities for the first time since 1990, then Japan will become the best performing market in the world. But that's definitely something to be aware of. China is a very different story. I won't go into detail in China except to say the market's cheap, but there's a real risk this market has become a value trap. The Chinese have temporarily turned Japanese in terms of being risk averse. Best chart highlighting the risk aversion is this chart, household bank deposits, chart in 53. Yeah, this is chart. The blue line is household bank deposits. So that shows you a surge in household bank deposits during the lockdowns last year. Big risk aversion. That risk aversion has peaked. The line is slowing, but it's still at a very high level of savings. You've got big prepayment of mortgages going on in China. So there are a lot of problems. They have turned temporarily Japanese. To me, it's too extreme to assume they've turned permanently Japanese. So there's a lot of issues in China, but it's not as bad as what you're reading about in the Western media. So this one chart just shows you the blue line is nominal consumption per capita growth in China. This year it's running above disposable income growth. They could cut interest rates a lot more in China because inflation is basically zero, but they're not doing that because they don't want to risk the currency. The other point, this shows you the property market. This has been the most important data point to monitor in so far this year. This has been driving market sentiment. In the first quarter, we had a surprising pickup in property sales coming out of the pandemic. That was a real fake out because it looked very promising, but what it was basically, it was all driven by people owning properties, upgrading. This was pent-up upgrading demand, which couldn't be completed during the pandemic, during the lockdowns. Then, however, by the end of Q1, all that pent-up demand had been absorbed, but then the market, there was no follow-through. So the sentiment really deteriorated dramatically in China because people had assumed a new property cycle had started, but it then rolled over. I've never seen a property market start a new cycle in one quarter and roll over in the second, but it relates to the unique circumstances of the pandemic. Meanwhile, we're hoping in India that there's a good chance, clearly, India attracts a lot of manufacturing investment with the PLI scheme and with the desire for people to move production out of China. But here you see the collapse in FDI in China, chart 66. Yeah, this shows the collapse in FDI. Meanwhile, China's not just sitting there doing nothing. Basically, China is in obviously quite an exposed situation. The US has effectively declared economic war against China when it set up this agenda to stop China having access to advanced semiconductors. Given China's demographics, that's squeezing China where it hurts, because the only way China can avoid the middle income trap is by upgrading its economy. And if it's not allowed access to advanced semiconductors, that becomes very difficult to do. So, this is really an extremely hostile act. As I said, they've effectively declared economic war. Meanwhile, China is shifting its exports. So this chart shows you that exports to the global south are now 36% of China's exports, whereas G7's only 29%, and that trend should continue. Meanwhile, this is a chart on the crude oil demand in China. So despite the weak economy, imports of crude oil and refined oil products in China are very strong, and this is not the reason for the weak oil price, as I said earlier. So I'll just now run through a few charts on India. Clearly, I remain structurally very overweight India. The interesting point is emerging market funds, despite them all being bullish India, are nothing like as overweight as you might think. Our analysis, this thing is not a science, so you can only analyze positions of funds at the end of the quarter. But as of the end of last quarter, our analysis suggests that global emerging market funds are only about 1% overweight the benchmark, which is nothing. And I think that reflects the fact that most foreign investors were expecting the Indian market to correct in early 22 when the RBI began tightening, as indeed were my colleagues. And normally Indian brokers are bullish on the market, but early 22 everybody was bearish because you had peak valuations and you had a start of a monetary tightening cycle. But what happened is the domestic flows continued, and basically the earnings growth caught up with the valuations. So my base case for now is we've seen the last rate hike. The near-term risk is obviously the oil price, but as I said, any sharp sell-off on the oil price is clearly a long-term buying opportunity. Credit growth remains healthy. The key macro point is that we're increasingly confident that we're seeing the early signs of a private sector capex cycle in India. And my base case for the last few years is this: we're going to repeat the cycle we had between 2002 2009, which started with a residential property upturn, and then morphed into a broader capex cycle. Clearly, we're now third year into a residential property upturn in India, which creates obvious multiplier effects. So here's the chart on residential project sales in the top 7 cities. So given the fact that we had a 7-year downturn in Indian residential property, seems to me quite like, there's no reason why we can't have at least a 7-year upturn. This is the inventory trend in the top 7 cities, clearly going down. And this is average residential property price changes across the top 7 cities. So if there's a concern here, is that the higher end is the real actions in the higher end properties. I think there's a lot of talk about the so-called, in Delhi earlier this year, I got the sense that government officials are a bit concerned about the uneven nature of the recovery. But when you get a property upturn, it's very normal for it to start with the high end and then trickle down. But clearly, it makes sense to come up with subsidized schemes for some lower end property, etc., to encourage buying. Housing affordability ratio does not look at all extended despite the higher rates. This is just the Indian Private Bank Index. This has been the core holding in my global portfolio. Core holding my global portfolio. The P of the market, not expensive. And this is my Indian portfolio, big weighting in banks and property stocks. And this is the green line's my portfolio, the dark line's the benchmark. So final comment, this is my global sovereign bond portfolio. Anybody involved in fixed income? I have a 20% weighting to India fixed income. I'm only in emerging market government local currency bonds. And my global sovereign portfolio is up 18.4% in US dollar terms since inception late March 2020. The global G7 government bond index is down 21% over the same period. That's dollar returns. So I'll stop there. Is there time for questions?
Yes, it is.
All right, okay, thank you.
May I invite you to take a seat here? May I invite you to take a seat here?
Sure.
Well, I've been told to keep it crisp. So I'm going to ask the most provocative question that's out there, donning my journalist hat, and it is this. You've made a projection for the Sensex to hit the 100,000 mark shortly. It's only a matter of time. That's what you've said. I think there are 3 parts to that. What is the time frame you're looking at? What is the basis for that 100,000 mark that you're talking about? And are there any risks? I'll keep it simple, and that's the only question.
No, to me, that's just a matter of time. So the good news right now is the ROE of the Indian market's rising again. Yes, so the only issue in my Sensex forecast is apparently nobody looks at the Sensex anymore in India. It's all the Nifty. So I think I've got the wrong target. But to me, it's just a matter of time. To me, that's not. So my key point to investors is any big pullback in India is a buying opportunity. So obviously the near term risk is the oil price, but I say the bigger the oil price spike, the more likely the oil then collapses because demand destruction. So this is an obvious buying opportunity. The other obvious buying opportunity will happen if the unthinkable happens and the government's not re-elected. Then the Indian market will be down 20% in a week, but then that's also a great buying opportunity.
Okay, point taken, succinct, and I'm going to request Avi to gift Chris Wood with the hamper and the money plant.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.